Hello and welcome to another Topical Tax Tips with me, Bernard Critchley, the Tax Manager at Aspen Waite. I hope you're enjoying the fortnightly bits that I put on the system for you, and I'd love to hear your feedback and comments, with the possible exception of a couple of people who've already given me feedback and comments. They can shut up, but that's by the by. Today I want to look specifically at some tax issues that affect the older taxpayer, an often overlooked group of people, but becoming an increasingly significant one. The first thing is a look at personal allowances. As we know, we're all entitled to normal personal allowances, but there is a married couple's allowance that's available if one or both of the married couple or civil partnership were born before the 6th of April 1935, although this may be reduced if the income is high in certain circumstances. In the sad case of when someone dies, then the full personal allowance is available in the tax year of death, and the married couple's allowance can be transferred to the amount that has been unused before the death of the first spouse. I've discussed areas of inheritance tax in previous videos, and the tax breaks that are available to family members with surplus income or small donations they want to make. So I won't mention them again here, but refer you back to a previous video. As a lot of people know, there's no liability to capital gains tax when someone dies. What happens is that the survivors will have the new asset treated as though they acquired them at the market value at the date of death, which is referred to as the probate value. And so by incorporating the CGT-free aspect of transfers between spouses, it may be possible to extinguish a capital gain arising on a long-established asset or share portfolio where one of the spouses is sadly terminally ill. I don't want to go in any further detail here, but if it's of a particular interest to anybody, then I'm more than happy to talk it through on an individual basis. So capital gains tax would still be chargeable in the normal way for disposals in the year of death, but if there are any capital losses, then those losses which aren't used can be taken back to the previous 3 tax years, the latest first, because obviously there's no capital gains that can be used in the future after someone has died. The whole area of moving into long-term hospital or residential care will be discussed in a future video, but it should be noted that there will be no charge to council tax on a property that is left unoccupied while the owner is receiving either care at another property, so maybe moving in with a family member, or residential care home, or a long-term hospital patient. It's often overlooked that if a property is left unoccupied for a long period of time, then in those circumstances the tax that would be paid, the council tax that would be paid, is able to be reclaimed if it's been overpaid, or the bill can be brought down to 0 if the payment hasn't been made. Sometimes people ask me other ways to get the most out of the family home when people are getting on in life, and the subject of equity release comes up. There are several schemes that enable homeowners to realise capital from their property, but this should not be entered into lightly. Proper financial advice is essential to ensure that the scheme gives security of income and doesn't put the home at risk. It may be suitable for some elderly people, but I do not propose to say anything further on the topic other than to say you should seek for professional financial help. And finally, a brief word about pensions. Some people don't realise that state pensions are taxable. What they might not realise as well is that tax isn't deducted under the PAYE scheme. So the personal allowance is reduced in the code number used against any occupational scheme or any personal pension. I've had considerable dealings over the years with tax being incorrectly calculated, either on pensions or other income, especially where the surviving spouse inherits their late husband or late wife's pension, with all the confusion of paperwork that ensues with such a difficult personal time. It's very difficult to get to the bottom of things sometimes when emotions are very high, and we need to be sensitive on those things. So, just a few thoughts on what to look out for with the older taxpayer. We're all getting older, we're all paying tax, we're all staying a little bit more spry than we used to, but there's no reason why we shouldn't look at financial aspects as we get older. They're equally as important as earlier in our lives. So until the next time, let's consider ourselves and our elderly relatives, make sure that everyone's aware of some of the things that are unique to the older person's tax affairs, because it may be more complicated than we originally think. Thank you. I know we've done a number of these videos now, and I'm sure that some of you have got questions or want to take things further. I'm more than happy to discuss things on a one-to-one basis with anybody. Our initial interviews are always free of charge, and you can contact me in a number of ways. You could choose the LinkedIn page that I use. You can email me at bernard.critchley@aspenwaite.co.uk, or you can get me through the website. And also, if you're one of those people that likes to speak to someone face to face, I'm more than happy to see you in the office here in Bridgewater. If you'd like to speak to me on the phone, the number is 01278 44 51 51.